Step back and see the macro and digest it down to the micro. Trading, investing, and geopolitics from macro down to the micro. Welcome to Macronomics.
Welcome back to Macronomics, guys. Today, I want to share something with you guys, as usual. Today, we're talking about bonds and what you need to know about them. So with that, let's go ahead and dive in, guys. So what is a bond? And how has it been used? So to understand this principally, let's go back about 800 years, right? So we are in Italy, Venice, I believe that's how you pronounce it. And essentially, bonds were around this time created. Now, they've been used for thousands of years, but as far as the modern times, how it was created in the modern sense. So essentially, the bond was created, and to break it down simply, Italy was financing or selling bonds, right? And pretty much, so the bond was, okay, I'm going to sell this. And again, I'm going to speak in modern terms to help us conceptualize this, because I don't know what the name of the currency that they used was called. So, look, I'm going to sell this bond, right, for $5. In a year, I'm going to give you $10. And that's the principle of it. That right there is the outline. I'm selling 100 bonds for $5. That's $500. If you buy all these bonds right now in a year, I'm going to give you $1,000. And of course, this was backed up with certain governmental institutions and politics and all that stuff and jazz and all that. Yeah, contracts and whatnot. So how does this correlate to us now? So bonds, guys, you have U.S. Treasury bonds. You have Great Britain Great Britain pound bonds. Pretty much every country issues some type of bonds, which is essentially a form of raising money. And the reason why today we're talking about this is because there's so much hype around interest rates. Like, what's the big deal? Interest rates. Like, what? Okay, you raise it a couple basis points. You raise it a couple, percent or two. What's that got to do with anything? Well, this morning, doing some of my reading, I was able to correlate some information, and it hit me with what's going on in the UK. So by the time you hear this might pass, but yesterday we was in a trade to the downside. And for any of you who don't know, essentially right now, the British government is buying up bonds because it's being sold off. I don't know if there's players in the market, and when I say players, I mean institutions and banks, because these are the forces that truly move these currencies. So they don't seem to have faith in the government paying back their bonds, right? Which is essentially what we already talked about, basically an IOU, and they're not paying it back. Or not that they haven't paid it back, but they don't believe they will. They believe there's a high risk of default. Just based on what's going on. And so the government comes in and they say, listen, we're going to start buying bonds. We're going to start buying stuff. And we're going to start buying these bonds to prop them up. And if you look at the chart, the Great Britain pound and the US dollar, there was a small surge. But if you look at the trend is still to the downside. And so we've been looking for some positions to follow up to the downside. But let's take it back to how this correlates to bonds. So the bonds, there's certain players right now in the market that don't believe that I don't know why I want to say London, Britain, the UK. You get my gist. So there's certain players that don't believe that they'll pay this back. And the reason, there's so many factors that play into this, but let's take it back to one of the biggest themes that affect this, and that's interest rates. So when interest rates are increased, right? This usually leads to was it down? Okay, wait. Yes, okay. If you get a chance, guys, look at the U.S. 2-year Treasury bond notes. I believe it was in 2020, right? I was just looking at it this morning. It was a huge fall to the downside. And this is because I believe interest rates, they decreased. And so the bonds, they fell. And so now, it's inversely, and don't I might have that a little backwards, but I'm pretty sure that when interest rates rise, bond yields they also rise. The reason being is because the principal is now owed more. And again, guys, I'm learning this along with you, so this might not be 100%, but we're definitely on the right track. These interest rates, they affect these bonds. Now, let's let's dive a little bit deeper. Now, why is this important? Okay, bond yields, okay, whatever. They go up, they go down. Now, the reason why this is important is because these bonds that are not paid back, if they're not paid back, this will disrupt the global economy. Why? Because there's no such thing as where we're at right now as a bubble. A bubble means something isolated from everything else. That's not the case because almost all property and everything is priced in some form of currency, right? Specifically being fiat. So if these currencies, if these institutions that back these currencies, if they default, this will ripple throughout the whole world, and not ripple, more like tsunami. And this is not something for you to be scared of. This is something that has to happen, guys. Like, how can the government, they just, whether it's printing money or whatever, they're buying up bonds from out of nowhere. Same with, there's just institutions that can create money out of thin air, and this creates problems, especially when it's you and put in the wrong hands. It's bound to be put in the wrong hands. You have something that controls the world, essentially. You can print money. It's just bound. Like, doesn't matter if you have it protected, people will fight nook and cranny to get to that. And so that's what we see happening, guys, with the bond and the interest rates. This is fluctuating, and then this is correlating to the equity markets. But that's minute compared to the bonds, because see, bonds, these are correlated to governments, and if governments default, I mean, what else do you have? You can't run a society without this. And so, to put this in a little bit more perspective, back in, I believe it was 1400, it was between 1200 and 1600, somewhere in that time frame, it was called the 100-Year Wars. And this was between England and France, and essentially it was a dispute. I don't know the subject of why. It was something happening, but it was essentially war. Now, these wars were financed with bonds, specifically from Venice, I believe. That's how you pronounce it, Italy. And what happened is they defaulted on these bonds. And this essentially affected every fabric of society, from clothing, from the top all the way down to the bottom. And around this time frame is actually when you had the Black Death or the Black Plague. And I think this is correlated because with the bonds not being paid back, and you have essentially, a lot of people's wealth being destroyed, people were put into extreme poverty, especially in rural environments, not even in natural environments. These were urban environments that were, you know, within England, where they had just too much people crammed together, and this caused a lot of the plague. So it was a confluence of events, guys, both financially, socially, and economically. But primarily, one of the biggest factors was from the bonds not being paid back. Now, the reason why we need to be aware of this is because within the UK specifically, this is a huge economy. I mean, on the world stage. So if they don't pay their bonds back, guys, this is affecting all other bonds, all other currencies, forms of exchange. It's just, it ripples out. And now this is not for us to be scared of. This is for us to be aware of. Because if this happens, or even if, because I mean, something's breaking, guys, as we know, within, like, we can't keep on this path without something not breaking. And when I say that, I mean, you have credit, you have the manipulation of these currencies and these forces by certain players that have eroded the market. But see, the biggest factor, this is the biggest factor that shapes the economy, guys. I'm gonna tell you. You run on it. I promise you do. It's called trust. Right now, if you have a credit card, right? You have a credit card. The way that you get more credit is by trust. Let me explain. Yes, you have the parameters that decide, okay, you pay back your money on time, you have this much and all the parameters, but at the end of it, if it was just a central theme, it is trust. You have a score trust. And 800 is, we believe you'll pay all this back. We can trust you. If you have a low score, we don't trust you based on your experience. And so this correlates to the bigger markets, guys, as above, so below. You have the UK. There's players within the market, and again, when I say players, I mean institutions, guys. These huge players, they don't trust, which is why these bonds are being affected. And so this is coming to fruition as I'm sharing this with you. I got some positions within within Great Britain pound and the US dollar. This is not for you to go trade it unless of course you understand what's going on and you have the specifics in place, like risk and whatnot, like we've talked about before. But remember, guys, you could be right about the direction, wrong about the trade. Good God, I've been learning this. I've learned this so many times, it's ridiculous. So, this is a rocky market. There's a lot of money to be made. There's also a lot to be lost. A lot of wealth is being evaporated before us, literally and figuratively, and specifically electronically, because that's where a lot of this money lays, not in paper, but electronically on these ledgers. So as we move forward, continue to be aware of the macrosphere so that you can move accordingly. Have your eyes open for alternatives as far as forms of exchange if this was to boil over and affect the whole world, because again, everything's connected, guys, and this is for us to continue to build our macrosphere so that we can move accordingly, guys. This is not to fearmonger. This is just what it is. You got to accept what is before you can change what is. And so it's time for us to continue to keep putting the macro to the micro. Get out there, get it done. Bonds, guys, bonds. IOUs, this is how governmental agencies work. Bonds. They issue bonds to raise money. There's many different types of bonds, from corporate to municipal to treasury. Just be aware and continue to expand on this, because as you move forward, you could create bonds, which is essentially IOU, right? These methodologies that are used on a macro sphere does not mean we can't use them on a microsphere. So with that, guys, continue to keep moving forward. Hey, if you're looking for something, shameless plug, let's say you're into self-sufficiency, hunting, gardening, and learning how to connect to the land, check out our other podcast. It's called Land Synergy. Land Synergy. That's our sort. We have been gardening, composting for a couple of years now. Slowly but consistently becoming self-sufficient. Not because we don't like the markets, just because we don't want to be 100% dependent on them. You could wake up tomorrow and the electronic gods have frozen your account. You don't want that. You want to be able to have at least some. You want your foundation to be in your land and in your skill sets around you, so that nobody could ever take that. So with that, guys, until the next one, keep putting the macro to the micro, and I shall talk to you in the next one.